Welcome to our discussion of certain common stock characteristics. We're ready to begin to dig a little deeper from the surface and take a look at some of the measurements that we use when we discuss stocks. But first, we're going to take a look at some characteristics of stocks. And the first one, starting on slide 60, is a spin-off. Stock spin-off. It's a conversion of one of a firm's subsidiaries to a standalone company by distribution of stock in that new company to existing shareholders. So a company decides to split itself apart for some reason, and you own their stock. Well, you're going to get stock in the new company. You might decide you want to keep it, you might want to sell it, but the stock in the old company is going to fall commensurate with the amount of value that was pulled out of the company. Sometimes the new company is still majority owned by the company that spun it off. For example, Altria, which used to be called Philip Morris, owned Kraft, and they owned Post Cereal and Miller Beer. I mean, they owned a lot of different things. And they started spinning them off. Kraft was the world's second largest food company at one time, and they spun that off. And they still owned a lot of the stock. And then when they spun off Miller, they sold it to a South African firm, and they still owned a lot of that stock. They then, Altria, what used to be called Philip Morris, spun off the international tobacco business, which is now called Philip Morris International. And that stock is based in the United States, but doesn't do any business in the United States. So it's an international stock. No, it's a domestic stock, but it does business internationally. And you receive stock in all these things, right? Not the not the Miller Beer, but the Kraft and the Philip Morris, and then you could decide what you wanted to do with those shares. The history of spinoffs has been checkered. Some spinoffs have done better than the companies that spun them off. In 1984, AT&T, the telephone monopoly, was broken up into the old AT&T, which was the long distance, and the Bell Labs, Western Electric, the manufacturing arm. And the local telephone companies became the Baby Bells, and there were 9 of them. And they actually started doing really well. In fact, they started merging, and one of them survived. It's now called Verizon. And the other one, Southwestern Bell, which was then called SBC Communications, got big enough and bought Pacific Bell and a few others, and finally bought the old AT&T and changed their name to AT&T. And people figured out that they really bought the company $16 billion worth just so they could have the name. Some spinoffs have not done so well. Coca-Cola Enterprises was spun off from Coca-Cola. Coca-Cola makes the syrup, which is turned into the soda. Coca-Cola Enterprises was the bottling company. They didn't do so well. Lucent Technologies, which was spun off from the old AT&T before they were then bought by SBC Communications, was a major disappointment. It almost went bankrupt. So sometimes it works out, sometimes it doesn't. But many investors are very keen on spinoffs because they believe, maybe mistakenly, maybe correctly, that it will unlock value in the company because now it's on its own. It doesn't have to worry about the other part of the company, and it can compete better. Well, sometimes it's true, sometimes it's not. A stock split is an accounting maneuver. A stock split is a maneuver in which a company increases the number of shares outstanding by exchanging a specified number of new shares of stock for each outstanding share. So typically you would have a 2-for-1 split. What did that mean? You have 100 shares and they split 2-for-1. You now have 200 shares. Whoopee. The price went down in half from $20 down to $10. You see, there is no increased value from stock splits. If you had 1 share at 20, you now have 2 shares at 10. The value is still the same. It's a psychological increase at best. Warren Buffett of Berkshire Hathaway, since since the 1960s, has refused to split his stock. He just thought, it's gimmickry. It's accounting. It doesn't create any value. A single share now goes for over $400,000 as of August 2021. There are 5 for 1, 10 for 1 splits, 3 for 2. You see, splits used to be important for trading because once a stock got high enough, it was difficult for people to buy 100 shares. And that's what they wanted you to, remember the technology? They wanted you to buy and sell in round lots. But now it's not important. Right now it doesn't matter what the stock price is worth. And there are even reverse splits. You have 10 shares, you now have a 1 for 10 share split. Now, why would they do that? Well, what happens is if the price gets under a certain amount, the exchanges don't want you. They don't, New York Stock Exchange, the NASDAQ, go away. If your stock price gets under $1, certainly, you got to go. So what they'll do is they'll do a reverse split. So if you did a 1 for 10 split, you had 100 shares, now you have 10, but the price has increased by tenfold. So you have a $1 stock, now you have a $10 stock. So again, it's an accounting maneuver. You have to try to look what's behind the split. In the quite some time ago, we were following quite a bit Qualcomm, and they split 2 for 1, and I wasn't quite sure why. And I'm trying to dig deeper, and didn't seem to be any reason why. And so I just figured Qualcomm is trying to tell people that things are looking good, without telling people things are looking good. Because if they say things are looking good and they don't turn out as good as they thought they were, they can get sued. But by splitting their stock, they're basically, giving a boost of confidence to the world. Take it for what it's worth. Treasury stock, it's an interesting name, has nothing to do with government bonds or the United States Treasury. These are shares of stock that have been sold and then subsequently repurchased by the issuing firm. They're called buybacks, share repurchases. These reduce the number of outstanding shares. The logic being that after the buyback, there is less supply, fewer shares outstanding. Existing shareholders now have a larger percentage ownership of the corporation. And you Econ 101 students, right, Economics 101, if you reduce the supply and the demand doesn't change, what should happen to the price? Right, the price should rise. All other things being equal, and they never are. During the run-up of the 1990s, share buybacks were often seen as a better alternative to dividend increases. The belief was that investors were more interested in capital gains than dividends, and that buybacks increased the potential for capital gains by reducing the supply of stock. This happened again with the 2017 tax cut. The Republicans reduced the corporate tax rate drastically, and the idea was to create more jobs and raise wages and the like. Well, no, the companies just took that windfall and bought back their shares. It was great for very wealthy people and for us investors, but not so great for the folks it was supposed to be for, with the employees. Oh well, nothing's perfect. Now, some companies will issue different classes of common stock. Slide 63. They might have Class A, Class B. As I remember, at one time, General Motors had 7 classes, all the way up to H, right? Yes, or G. Different classes will have different voting rights, different privileges. Maybe the Class B shares are for the family, and they get a lot of dividends, but not really any say in the say. They don't get a whole lot of say or a lot of votes. And others, Farcebook is very big on this. They created a second class that only the CEO and some of the insiders own, and they have far more voting rights than the regular class shares that we investors buy. So it basically says that, hey, I'm going to keep control of the company no matter what happens with the number of shares. You can't outvote me. There's a bit of a backlash to this, so we'll see what happens. There's a bit of a controversy. If you want to look it up, just type Farce Book or Fleece Book or whatever the name of that company is, and then share classes and see what comes up. Berkshire Hathaway has two classes. They have the Class A shares, the original shares that are selling for over 400,000. But then the investment world, Wall Street, was very upset with Mr. Mr. Buffett because he never split his shares. So they started to give some noises like they were going to take things into their own hands. And so he relented in the mid 1990s. He issued a lower cost version of his stock, the Class B shares, which really weren't that low cost. He's, at the time, I think the Class A shares were selling for 30,000, 35,000, something like that. So he came up with the Class B shares selling for $1,160. And then in the prospectus, he said he wouldn't buy them. He said, if you want to buy Berkshire Hathaway, buy the Class A shares. And then the Class B shares did fairly well, and Mr. Buffett realized, hey, I can use these things. He split them 50 for 1. Yeah, you had 1 shares, now you had 50, but the price, of course, went down 50 times. And then started using them as ways to buy other companies. He used them like cash. So he said, hey, it worked out. The guy's, the guy's not dumb. And now they sell for about $290. But again, Mr. Buffett wants you to buy the Class A shares. And you could buy 0.0000001% of 1 share by buying, putting in $50 or something like that. Don't do it. I'm sure they're going to give you a really bad price. Whoever does that for you, the brokerage firms. Slide 64. Some common stock values. The par value is fairly meaningless. They set it at 1 cent or $1 or 0.001 cent. It's the face value of the stock, meaning that the stock will never go below this number, but it's meaningless. The book value is important, fairly important, especially to accountants. That's the amount of shareholders' equity in a firm. So they take the assets and subtract the liabilities. Sound familiar, you accounting folks? Or from Business 121, Financial Planning and Money Management? And what you have left is the net worth, the equity. You divide that by the number of shares outstanding, and that's how much each share is worth on the books. Now, this is all accounting. They've depreciated a lot of those assets, so you really don't know what the market value is if you were actually trying to sell those assets. But it gives you a good idea of what the company is worth if it were to be broken up. If you were to sell all the assets, pay off all the debts, what would be left over? But we don't usually concern ourselves with that. We'll look it up, but the market value is far more important. That's the prevailing market value of the security set by the forces of supply and demand. And we'll take a look at valuation in detail as we move along in our chapters. There's an interesting phenomenon that doesn't happen too often, but when it does, the world sits up and takes notice. Sometimes the market value falls below the book value. Yeah. Now, what happens then? The corporate takeover artists, the corporate raiders, the vulture capitalists, private equity firms, they like to call themselves, will swoop in and buy 50% plus 1 stock, which means they now control the company. They will liquidate the company, pay off the assets, and hopefully walk away with money in their pocket. Now that's capitalism. How would you feel if you worked for this company for 22 years and a vulture capitalist came running in and liquidated the company? You're out of a job. You wouldn't be too happy. So you would call your elected Congress representative, and you would scream and holler about these corporate raiders and how they're ruining our communities. And the congressman would say he's concerned with I will take it under consideration, but you know what? This is what we want to happen. This is capitalism. That company was not, that capital in that company was not being efficiently utilized. We needed to, like a farmer plows the field, plow under that company and unlock that capital. Not only the resources, the plant and equipment, but also the humans, the human capital. You should be working somewhere else because you could be contributing to the economy in a much more efficient manner. And it sounds so clinical and amoral, doesn't it? Well, that's capitalism. And that, dear students, is why we have unemployment on insurance. It's not to pay people not to work. It's because we want this dynamism in our economy. We want those people working for companies that are contributing, that aren't foundering. It's not perfect. Slide number 65, dividends. Oh boy, dear students, I sure do love dividends. Dividends are distributions of earnings given to stockholders. In the United States and all countries that at one time had something to do with the United Kingdom, Canada, South Africa, Hong Kong, Australia, and the UK itself, dividends are normally paid quarterly. Outside those countries, they're often paid semi-annually or typically annually. They'll pay you once a year. The board of directors decides how much, if any, dividends should be paid and when they should be paid. Dividends are usually set as a percentage of the earnings per share. Earnings per share is a very important number, dear students. It's the amount of annual earnings available to common stockholders stated on a per share basis. So it allows us to think of our one share of whatever as a little factory, as a little business. And that one share is earning 75 cents a year or 25 cents or $2 or whatever. You see? So then the corporation can say, the board of directors can say, we earned $1 or $2. Let's pay out $1 to our shareholders. So here's an example that I think I was just using here. The company reports a net profit of $1 million. Now, is that a lot of money? Yes, to you and I it is. To you and me it is. But we don't know how many shares are outstanding. Well, there's 500,000 shares. Okay, so you take the $1 million of earnings divided by the $500,000 in shares. 500,000 shares, I'm sorry. Not dollars in shares, but shares themselves. And you have $2 of earnings per share. So the board of directors might decide to pay out 50% of the earnings per share in the form of dividends. Therefore, each shareholder would receive $1 dividend for each share they owned. This is called the dividend payout ratio. The company is paying out 50% of their earnings to shareholders in the form of dividends. It's pretty straightforward, folks. Make sense? Mature companies tend to have higher dividend payout ratios. Why? Because they don't need the earnings to be reinvested for growth. They are already mature. Whereas newer companies, growing companies, they need those earnings, so they retain those earnings and use them to reinvest back in the business. And you accounting students know that whatever earnings are not distributed in the form of dividends, we call those retained earnings. Cool. Okay, good. You remember your accounting. Now, the dividend yield is a very important measure. Why? Because this relates the dividends to the share price and puts the stock dividends on a relative percentage basis rather than the absolute dollar basis. Remember, way back in chapter 1, we said, it's important to know what our total dollar return is, but it's also important to know what our percentage return is, because this allows us to compare the investment, in this case the stock, with other income-oriented vehicles such as bonds or savings accounts. If the stock in the previous slide was paying $1 dividend, if it were selling for $20, the dividend would be 5%. $1 dividend divided by $20 of price, and that's 5%. Pretty straightforward. And again, we just look it up. Traditionally, 3 to 6% was normal. But then in the 1990s, the dividends went down to 2, and then finally in March of 2000, the height of the internet bubble, they hit 1%. They then shot up over 3% in 2008 and 9 as the price went down, because remember, you either got to make this number bigger, the numerator, or this number smaller to make the quotient bigger. It's a quotient, numerator divided by denominator. And now they're back down below 2%. But hey, savings accounts aren't paying that much, are they? No, they're not. And bonds aren't paying that much either. So a dividend of 2% is pretty darn good these days. Now, there's some important dates for us to remember here. The declaration date is the date that the board of directors declares a dividend. They say, okay, on June 17th, we're gonna pay a dividend. Now, it's in May sometimes, so they're giving you plenty of time to know when and how much. The date of record is the date on which the investor must be a registered shareholder of a firm to be entitled to receive that dividend. So you have to own the stock on that date of record. However, you really have to have purchased the stock by the ex-dividend date, 2 business days before the date of record. That determines whether one is an official shareholder of a firm and thus eligible to receive a declared dividend. Now why? Hang on a minute, that's the next slide. And then lastly, you don't actually get the money on that date of record. It comes in about 3 or 4 weeks later into your account. They used to send you a check. It's all electronic now. You can still get it. You can still ask them to send you a check. They don't want to do it. It's just like your bank doesn't want to send you a statement every month. They want you to do everything electronically because it saves paper and money. So now let's ask ourselves, why is the ex-dividend date 2 days before the date of record? Well, it's very simple. Because stock transactions close in 2 days. We may have mentioned that mutual fund transactions close in 1 day. You buy the mutual fund on a Tuesday, and then the next day, Wednesday, you actually own the shares. And the same thing is true when you sell it. If you sold it on Tuesday, the money is yours on Wednesday. Well, stock transactions used to close in 5 days, 5 business days. And then for a few decades, they were closing in 3 days. But now with technology, they close in 2 days. So, for example, if the date of record was June 17th, you would have to you have to purchase the stock before June 15th, because you do not actually get it until, you have to purchase stock on June 15th because you do not actually get the stock until June 17th. Theoretically, the opening share price on the ex-dividend date should reflect a drop in price commensurate with the amount of the dividend. Because if there is a $1 per share dividend, the opening stock price should be reduced by $1. Because you see, they're sending $1 for every share. So theoretically, the stock price should drop that much on the opening of the ex-dividend date. But it doesn't work that way, folks. The marketplace doesn't work that way. The prices are changing all the time. So, theoretically it should happen, but that's not what happens. You will hear people in the industry say, don't buy the dividend. Okay, what's the translation? You're often better off waiting until the ex-dividend date before buying the stock. The logic follows thusly. Dividends are taxable transactions. If you buy the dividend, you buy the stock just before the ex-dividend date, you will be responsible for paying the tax. And presumably, the stock price will fall commensurate with the amount of the dividend. So, you're better off waiting until after the ex-dividend date, so you're going to get the stock at a better price and not generate a taxable transaction. Well, this, for most of us who are not making huge purchases, this is really kind of silly. I mean, it's not going to amount to a hill of beans. And when it does, then when it really is a lot of money, then congratulations, and you won't care anyway. So So my apologies, I ran too fast. I think it's kind of silly. I don't think you should have to worry about this. Now, if you were, this happens in mutual funds too. At the end of the year, mutual funds, especially stock mutual funds, will announce their dividends and their capital gains for the year. Some pay capital gains quarterly, but most all pay capital gains. I'm sorry, some pay distributions, dividends quarterly, but most all pay their capital gains at the end of the year. So if you really were going to make a big investment in a regular account, not a retirement account, because it doesn't matter. You don't pay taxes until the end unless it's Roth, and then you don't pay any taxes. But if you were going to make a big contribution, a big investment at the end of the year, you would want to take a look at how much they usually estimate. They don't know until the day, but estimate. The companies will estimate what their capital gains will be. And if you have a financial advisor, ask them. They keep up on these things. At least I do, because the companies send out their estimates for their capital gains so that you can plan accordingly. But again, if it's a lot of money, then congratulations. So now, slide 71. Very important, because if you don't remember the difference, all you got to remember is that you want cash dividends. You want a payment of the dividend in the form of cash. You do not want stock dividends. And why is that? Well, cash dividends, they're giving you money in your pocket. Now, they don't send you a check anymore. It goes electronically into your account. But stock dividends are payment in the form of additional shares of stock. But all else being equal, and of course they never are, stock dividends have no value because they constitute a dilution of ownership. They are similar to a stock split. So for example, the board of directors declares a 10% stock dividend. For every 10 shares, you receive 1 extra share. Oh boy. Correspondingly, the price of the shares dropped 10%. But unlike a cash dividend, a stock dividend is not taxed. Well, gee, thanks, IRS. Isn't it nice that they don't tax you on something that's not worth anything? So a stock dividend is similar to a stock split. It's an accounting maneuver. They're not giving you anything. Now, here's where it gets a little tricky, because dividend reinvestment plans look like a stock dividend, but they're not. They're not the same thing. And I love the name, DRIP. Isn't that what you want? Yes, you want DRIPs. DRIPs are cool. A dividend reinvestment plan is a plan in which shareholders have cash dividends automatically reinvested into additional shares of the firm's common stock. This is a taxable transaction. No additional shares were issued, and hence no dilution of ownership occurred. What did the company do? Well, they went out with that dividend and bought more of their shares in the open market. Now, they don't do it. Somebody does it for them. But if you go to one of the old companies and go to their websites, typically they'll have a dividend reinvestment plan, and somebody runs it for them. In fact, there's an example on the website and in Canvas that you can take a look at through Sempra, SDG&E. So it is a taxable transaction, but they're not giving you the money in cash. They're giving you the money in shares. Well, this is how mutual funds work, folks. Mutual funds, the default is a dividend reinvestment plan. And it used to be that brokerage firms really didn't want to be bothered with this, but now they do. Now they're involved because they see people are interested in DRIPs. And so most all brokerage firms will allow you, when you set up your account or when you buy the one company's shares, however many shares you buy, you say, I want to be reimbursed with not new shares, but more shares. I want my shares I want my cash dividends to be automatically purchased more shares. Okay? Dividend reinvestment plans are an excellent way to own stock for those interested in long-term growth and are not interested in current income from the dividends. It allows the investor to take advantage of compounding automatically with normally or very small transactions. The DRIP that we had in the investment club I was in, every once in a while they charge us 6 cents or 9 cents or 3 cents. It was very, very low, this is when, there weren't $0 commissions at this time. It was about, not quite, yeah, about 20 years ago. My goodness. Um, so, um, so check out drips. They're very cool. Very, very cool. I like drips because they're like mutual funds, and you buy a company that's very well diversified. It's kind of like buying a mutual fund. Not the same. No, it's not exactly the same, but it's the same idea. Compound annual return. Okay, enough said. Our last slide, we will take a look at the most popular stock market statistic, and that is the price to earnings ratio. The PE. P is written P/E, or sometimes written PE, not to be confused with physical education. It's a very simple calculation. You take the price of the stock divided by the earnings per share. So if we take a look at that $20 stock with $2 of earnings, you take $20 divided by 2, and you get 10. Now don't put a dollar sign, don't put a percent sign. PE is unitless, but if you do, I'm not going to scream and holler or anything, but just there's no units on it. A 10 PE is these days very low, but traditionally stocks sold for PE ratios of 5 to 15, and PEs of 20 or higher were only reserved for the fastest growing stocks. But during manias, PEs of 20 or more are not unusual, like the 1980s and especially 1990s. During downturns, PE ratios come down greatly. Why? Because the price comes down greatly. But if the earnings also go down greatly, then you can see how it's a ratio, right? Price divided by earnings. You make the numerator bigger, you make the quotient bigger. You make the numerator smaller, you make the result smaller. If you make the denominator bigger, you make the result smaller. If you make the denominator smaller, you make the result bigger. So you got to make sure you understand that relationship. It's not that hard. Play with it. Put a few numbers one on top of another and see how they work together. We will spend a great deal of time learning about price to earnings ratio and other valuation techniques in our next 2 chapters. So I know this stuff's a little tedious, but we want you to study it, and we have a worksheet number 2 that we want you to go through because it asks you to compute the dividend payout ratio, the dividend yield, the price to earnings ratio, and then it asks you a few questions about the material that we've looked at. Like where would you find certain stocks? What exchange? What NASDAQ, New York Stock Exchange? Where in the stock market would you find them? And remember, you have to go look it up to be sure. And then there's some calculations that we actually won't do for a little bit, but we'll do them. Don't worry. They're on worksheet number 3, so stick with us. Okay? Dear students, we're so proud of you. We've got a ways to go. I know. I told you it was a long march, didn't I? There's a lot of material in this chapter, but it's worthwhile because you are going to be the investment guru. I guarantee it.